record. Okay. So this is part 2 of today's class being recorded. We'll now address the Article 4, following up where we left off. I have the classroom open already. I'm going to open up Tax Analyst, which I prefer to use, always with my disclaimer that they're just as good. You can use CCH, you can use IBFD, and all the other databases. By the way, if you like the databases and so forth, we're adding several new databases this week. One of them I saw went up already. Very cool database. And I'm sure everyone has had a chance now to look at our CCH compliance materials with all the forms translated into English from all the different countries and the other stuff. For the Checkpoint International Tax Expert and Compliance Software, you need to email the library and ask them how to access that, because it's not up here yet. But the new database, which they just installed, is the previous was MUML, which is like 75,000 books. The Making a Modern Law Digital Archive, but that's not the one. That was installed a few weeks ago. The new one is I'm not going to remember now. When they installed it, I saw it go up a few days ago on the test site, and it was. Oh, and I know the other one they're getting is International Law Reports. The International Law Reports, ILR, which are produced by Oxford. Yes, by Oxford. Yeah. They're going to be online within like a week. They will be here probably by Friday. They're under the International Law, Foreign and International Law section. And for those of you who are doing like treaty research, state-to-state treaty research, where they have public international law conflicts with treaties, I know that 1 or 2 people are doing theses on that. Obviously, I'm speaking to students who aren't in the room right now, who aren't here. Okay. So here we are under our normal databases. So I'm going to go click on Tax Analyst. Under Tax Analyst, I'm going to click on Worldwide Tax Treaties. I'm going to slowly wait for my menu. No, it's not coming up. Click on refresh. There it is. I'll click on my model convention. I'll click on my income and capital, and we're going to go to our Article 4. I want to do today's lecture based on the case, not really a case, a ruling that I posted yesterday as an example of the issues we've been speaking about the last 2 weeks. This is now week 5 of the class. By the way, let me segue to make sure on the lectures everyone understands where we're going with the lectures also. If you look at the syllabus, I think it's pretty clear. This week, you're supposed to have Alan DeCoker kick in, so I have to finish the Article 4, so he can start 5 on Thursday. Then, next week, you have Alan DeCoker, and you'll be doing Article 5. So you got to go the definition part of Article 5, and I'll sit in on the lecture anyway, so I can add my 2 cents, because I used to be an Article 5 expert. I don't practice anymore. And if you don't actively practice, and I tell people this is very clear, because some people say, I want to go into teaching. But understand, if you're a professor, you don't practice anymore. It's one or the other. You either practice or you teach. You can't divide your time between 2 things and be great at both. And so if you're teaching, you're no longer practicing. And if you're no longer practicing, well, you can have a lot of research knowledge. It's not the same as being in the trenches of every day having to manage resource of your time and your billing amongst clients who have issues on a particular issue that you are the professional expert on, who's sitting there in front of revenue authorities with the real gist of the arguments. So I'm no longer an Article 5 expert in the sense that I'm not practicing anymore, I'm teaching. If somebody is, every day of their life writing memorandum, discussing with revenue officials different aspects of trading income, business income, Article 5 definition to decipher Article 7, the taxation of business income under treaties, that makes you an expert. So I can have literature knowledge, but we will have, that's why we have Deloitte and KPMG providing their perspectives from different country perspectives. So we have pre-recorded lectures from them or live webinars on China, on different aspects of Asia, Brazil, the BRIC countries, Brazil, Russia, India, China. I encourage everyone to attend those because you get a totally different perspective than the academic, than the literature background. Luckily, of course, I have practiced extensively in Article 5, and since there's a lot of professional work in Article 5.7, obviously it's something you should be focusing on, but you can never get there if you don't have Article 4 understood thoroughly. And to help you understand the conflicts that result in Article 4, that's why I posted the ruling out of Italy yesterday in your forums. To make sure we're all on the same page, I'll show you that ruling in a moment. I'm sure that everyone saw it because I emailed it through the class. Okay. So let's summarize what we've covered before, and then we'll go into today, because I always do the summary. With Article 4, I'm not going to open the screens this time. We did that last week again. But to get to Article 4, we first had to understand 1, 2, and 3. Now, 3 was just definitions. The definition that we needed to understand from 3 was the definition of person. And so we discussed a person in the context of natural people, you and I, and we did it from the perspective of corporations, trusts, tax-exempt vehicles like pension funds, and to show you, in your form you have like static versus ambulatory approach to treaties, and I'm a big believer in static approach, kind of like I'm a believer in the Constitution is static, that it shouldn't be, regardless of that the system was perfected absent massive transformational changes in the current situation. We should leave it alone. The same with treaties. To show you that the evolution process, so the ambulatory process, like tax-exempt entities, while we've had charities for a very long time, tax-exempt, call it entities, have been around in the United States since, late 1700s, 1800s. They really got popular in the middle 1800s with universities in particular. But and we've had them in the UK since literally the 1200s, but 1400s, 1500s, the Act of Elizabeth. The pension funds, which we all think about as this, is where all the money's. They're getting a lot of discussion today because they're institutional money, and there are a lot of pundits are saying that money is being held up by pension funds and it's no longer being invested in stock market. And pension funds includes 401ks and so forth like that, IRA accounts. But really, those only been around since the 50s, as we know them, 50s and even 60s. It's fairly new stuff in the context of history, but the tax code is fairly new stuff in the context of history. Taxes are really a phenomena as we know it today in the from the 1930s onward. And we know from tax history courses, for those of you who go through that, and at some point we'll have tax historians do lectures for us. I have studied the history of tax and so forth, but there are many different perspectives. And in the second lecture I sat through yesterday, which I mentioned in part one, was on tax history. It was tax history of corporations, very interesting. And so when we look at treaties, and we look at persons, and we talked about persons being pension funds, REITs, real estate investment trusts, like partnerships almost, but a little bit different, almost like mutual funds, unit trusts from Europe. These entities, when the Article 4 was conceived of, and persons and so forth, these entities didn't even exist at that time. And so if we look at the history of tax treaties, which you get partly from the commentary itself, and the development of the model, as we previously discussed, the model is just a perspective of negotiation for the OECD members and some non-OECD members who refer to it. And you look at tax itself, and you look at commercial business, whether the commercial business is for-profit or non-profit. It's interesting to see how these don't neatly fit into each other. That Article 4 had, persons, the definition of persons, before there were persons as we understand today, like the REITs and the pension funds and so forth. Anyway. Okay, so that we covered that. We looked at Article 1 because the treaty only applies to persons, Article 3, who are resident. And thus we came back to Article 4 because we need to know who's resident and who's not resident. With that in mind, I pop open our classroom, we look at our forums. I'm opening the Module 3. Student view. Great. For Tuesday's discussion. Well, there's Alan de Coker, French domestic law, I see up there. He's asking a case study about France and the French Constitution. Interesting. Anyway, here we have the situation. So what are the issues brought about in our Italian holding? Well, I've laid them out for you in the sense of it touches on domestic law, treaty law, use of the commentary and the opt-outs, management control versus real seat. Okay. So, for those of you who perhaps didn't have a chance to look at this, read it quickly now, as you are obviously doing. And what's interesting here is, and this is going to bring us to the tiebreaker, what we're discussing today. What's interesting here is and we mentioned management control already in our previous lectures, and we talked about real seat. Although I have to remember, was that in this lecture or was that with you, resident? It was between me and you. Did I do real seat in the classroom? I did do real seat in the context of commercial versus fiscal law. Sometimes I'm asked a question here on campus, and I forget if I was lecturing here or online. Okay, so there is a difference between management control and real seat. And that is covered in your Principles of International Tax Materials and in your Chapter 6, your Module 6 for tax treaties under the residency materials. It's also discussed in your commentary. And in particular, Italy has a opt-out as regards the tiebreaker test for Article 4 management control, which we're going to be discussing now, today, immediately. So here you have a Dutch company that, in one way, is clearly resident in Holland. It's a holding company, and that holding company has a subsidiary in Italy. But Italy is stating, as you read, that the Dutch holding company, which on first glance is clearly resident, certainly under, now we have to actually go through the interpretation and the application of the domestic law and the treaty, but on first glance is clearly resident in Holland, but yet Italy is making an argument that actually it's resident in Italy, and Italy is allowed to fully tax it, to apply unlimited tax liability to it. So let's examine our situation from a point of view of application of the domestic law and the treaty. Now, under domestic law in the Netherlands, what makes a company resident in the Netherlands? Feel free to chat your answers. I don't see anybody responding. So you're saying that Holland applies the management test? Well, can you cite me some source on that? Do you want to expand that Holland applies the place of effective management? Yes.
Is Holland is Netherlands?
Yeah, Netherlands. Yeah, from my note.
Yeah, it is incorporation and central management control.
Yeah.
Explaining.
Yes, correct. And I was hoping you'd cite the law, but anyway, she did. So the source of it, and so we have the citation to the code, but anyway, we're really looking at Article 73, in this case 5 bis, and its conflict, potential conflict, which we're saying is not a conflict with the treaty. The problem is we're citing Italian. I was asking for the Dutch, but yeah, let me make that come alive. Okay, so we're citing the Italian rule. That's not the Dutch rule, but anyway, okay. So in the other course, international taxation, I've listed the Dutch rule for you. Anyway, in the citation law. Okay, so step one of the analysis is I have to look at. Step one of the analysis is I have to look at not the treaty yet, which I put on your screen. Let me minimize the treaty so I can have all my windows open at the same time. Okay. Step one of the analysis is that I must look at, first of all, is there an overlapping, is there a conflict between two states? That means step one requires, and now I'm harkening back to the whole Michael Edwards Kerr theory here, is there a conflict between two states, meaning do two states seek to exercise fiscal jurisdiction on either the subject or the object of our fact scenario, the subject being the persons, the object being income. So first, Holland. Under Holland's domestic law, a company incorporated or having some aspects of management in Holland, and it's not management control. Having some aspects of management in Holland, more like the real seat theory, which is a civil law theory, allows Holland, or creates a sticky enough connection, breaches a threshold of corporate personality or activity in Holland that the Dutch government uses then to exercise its unlimited tax liability upon the company. So it chooses to exercise its fiscal jurisdiction on the company, domestic source and its foreign source income, worldwide income taxation on the company. That gets us part of step one. The company has exposure, has some connections to the Italian market. The connections are, it has an investment. The investment in the Italian market is, I see the students actually starting to come to class now. The investment in the Italian market is via shares. It has an equity investment in a subsidiary. Normally, and this addresses Article 5, normally this is addressed under Article 5. I'll save that for Alan DeCoker. But Article 5 says that just because you have shares underlying subsidiary doesn't mean that subsidiary is your permanent establishment of, in this case, a holding company in Holland. That's for Thursday and next week. The interesting aspects of this particular nexus are that in this step 1 analysis, where we have to see if there is a overlapping claims, overlapping jurisdiction by two different states to create an issue, Italy says under its domestic law, and it's a decree, under its domestic law, and where's this specific mention? Okay. Now, it says that this isn't about their own interpretation of their law, the 73. This is about the validity of evidence provided by the taxpayer. But the point is they highlight that Italy is saying, well, in Italy, we also, like Holland, under our domestic law, seek to exercise our fiscal jurisdiction authority, that is to levy worldwide income taxation, a limited tax liability, upon companies that are resident in Italy, resident defined as companies that have a place of effective management in Italy. So I asked you the question to start with, what is Holland's test? And just my initial going through the chat, it seems like I'm being answered for Italy based on being cited the 73 bis, which is the Italian rules, not the Dutch rules. Okay. Now, so here I have step 1, I have a conflict. Italy is saying, we apply something similar to Holland. It's not the exact same. It can't be the exact same. Why? Because this isn't harmonized in the EU, and the Dutch is under the Dutch language, and the Italian is under the Italian language, and as we've already discussed with languages, even the word income for the UK and the word income from America, both being English language income, mean different things. And because it's all illegal fiction. Susanna says, I cannot get on the proxy server. You need to contact the help desk if you can't get on the proxy server. help@tjsl.edu. I'm on the proxy server right now, so it definitely works, since I'm showing you the tax analysts on the proxy server. The other two aren't. Westlaw is direct and MegaMeeting is direct. But I'm on the proxy server looking at tax analysts. So, step 1, we established under the domestic laws of two countries an overlapping jurisdictional claim on the same subject, i.e. this holding company. As tenuous as the Italian position may be, under domestic law, Italy reigns supreme. It's their approach, their interpretation, i.e. the government's, doesn't necessarily mean it's right as applied to this fact situation. Now, we have a proxy. I hear Hester talking about the proxy, actually. One second. Are you having issues with the internet or not? I take it back. I'm on proxy, but Hester's having issues with the internet, so maybe it is something. If you email the help desk, what it may be is that they're, I'll tell you, if you're having proxy server issues right at this moment, they're implementing the new, they're putting in the new system in IT right now for the new video conferencing system. And it might be conserving bandwidth or shutting down one of the servers to implement this new server, which is being put in right now. Although it seems to be working, obviously, on my machine. So here we have our conflict established. Italy is saying that potentially, although they want to, it's potentially, because I don't think they're actually saying this in this situation, but I haven't looked at the Italian decree. I don't read Italian. They're saying potentially, or they are definitively stating that they are going to exercise unlimited tax jurisdiction on the holding company in Holland. Understand what that implication of that is. The holding company in Holland, from its perspective, has this investment in Italy. It owns a company. But the holding company in Holland may have 100 other investments. I mean, imagine if it was like the holding company of Philips. It was Philips Corporation. And here is Italy stating that by fact of this investment, and that it manages this investment, that the holding company falls afoul or breaches the level of activity necessary for Italy to impose its jurisdiction on it, i.e. Italy now can tax all the income of the Dutch holding company. And you say, well, how's Italy ever going to get its hands on it? Practically speaking, the directors live in Holland, and well, there's in the EU, there's a mutual collection agreement from the EU, and certainly under tax treaties, that's a new added to tax treaties. The countries help each other collect their taxes. You'd have to imagine that Holland would probably balk at giving up its own tax revenue, what it considers its own tax revenue, to Italy. But regardless, step one, the conflict has arisen. Step two, analysis. Step two. Our Dutch company, incorporated in Holland, says to the Italian authorities, they don't need to say this to the Dutch. The company considers itself a Dutch company. It considers itself resident in Holland. Under our step one analysis, the company considers itself resident in Holland, does not consider itself resident in Italy. Italy considers it resident in Italy. So it makes no sense for our Dutch company to go to the Dutch government and say, I have a treaty protecting me. The Dutch say, you have no conflict with us. You think you're resident, we think you're resident, end of story. So the Dutch company goes to the Italian authorities and says, we have a treaty protecting us, step two, treaty protecting us from you, that you signed with our government. We think we're Dutch, the Dutch think we're Dutch, so Article 1, we're covered, and we're seeking protection pursuant to this agreement between Holland and Italy that you cannot impose unlimited taxation, in fact, any taxation upon our company. Now, the Italians say, shouldn't you be saying that to Holland? Because you're an Italian company, from a tax aspect. You're an Italian company. You are resident in Italy by nature of our domestic rules, our interpretation of our 73. So, scrolling down to paragraph 3, which I've highlighted under the model treaty on the left-hand side of your screen, we know that the model treaty has that all the nations have agreed that from the perspective of one connecting factor test to another connecting factor test, that they've chosen that effective management is the tiebreaker test to be used where a company is actually resident when two countries claim overlapping fiscal jurisdiction to tax it as a worldwide income. So we have to use paragraph 3 of Article 4 when the person is other than an individual, other than a human being. So this applies to every other type of person as we examined under Article 3. That would be trust, REITs, anything you can come up with that's not a human breathing individual. Okay, so when you have something that's not a breathing human individual, and we now have the overlapping conflict, then it shall be deemed, so between the two nations, the one that gets to exercise, and I mentioned 2 or 3 weeks ago, winner versus loser state, W and L. This is a WL situation. So the winner state, the deemed residency, i.e. the state that is deemed to be the winner, the tiebreaker of who gets to levy unlimited taxation. And if one state gets to levy residency based on limited taxation, i.e. worldwide income tax, that leaves the loser state with only the possibility of levying source, income taxation. We'll get to that in a moment. Is deemed to be where the effective management is. Okay, so we're in step 2. Looking at the treaty, our Dutch company goes to Italy and says, we're protected from you. Look at Article 4, paragraph 3. And what does Italy do? Now, there are 2 currents of thought, and we have notes on this later, especially dealing with Article 5, but I'm going to express the 2 currents now to set up this discussion later for Alan de Coker. There are 2 currents of thought on Italy's analysis, the government's analysis, the revenue's position on paragraph 3, and I don't just mean paragraph 3 on any aspect of the treaty, any article, application of the treaty to this situation. The first thought is public international law thought, and this is what I think. I support this, but everyone make up their own decisions. I think that countries, in interpreting their rule in respect respect of or in relation to a treaty article, in this case paragraph 3's tiebreaker, that they cannot then refer to their domestic jurisprudence as a possible, as an influential, referential, precedential aspect of interpretation that, so in this particular case, Italy cannot say, well, this company has effective management because we're applying, under the Italian test of effective management, well, this company meets the aspects of our test, the criteria under our test, and thus the effective management is in Italy, and thus too bad Holland, the tiebreaker's in our favor. Or too bad, really, Dutch company, the tiebreaker's in our favor. But it is too bad Holland, you're the loser state, you don't get to collect the revenue, we in Italy get to collect it. Or, we don't care if you collect it, we're going to collect it anyway. Take a credit. That's your problem, not ours. The Italian government seizes the company's assets, like the subsidiary in Holland. Says, oh, you don't have to pay. Okay, we'll just seize your assets. We're going to levy on them and sell them off. Expropriation. So, I think that when two parties come together and agree a treaty, and I'll tell you the holes in this trend, this line of thinking, but I think that they should not, pursuant to public international law, refer to their own interpretive, jurisprudential, circle back to their own domestic law cases, concepts for application of the treaty article to the situation. One reason I thought, or other commentators would think not, is that the reason you have a conflict in the first place is the interpretation of their domestic rule and the interpretation of another country's domestic rule with which it has this agreement, this tax treaty with. So, it's always going to come back to step one, country seeks to impose tax. Step two, treaty article. And it ends. If the treaty article is interpreted in the context of the domestic rules, well then, why have a treaty? Because the country that's interpreting it will always be interpreting it in its favor using its domestic law, which is why you had step one's conflict in the first place. If you have no conflict, there's no issue, there's no treaty to be brought in. So everyone get that? If a country like Italy says, oh, well, we're happy that effective management is the tiebreaker because the effective management's in Italy. Well, you're always going to be back to the original conclusion of step one. However, okay. Now, one could, in the first trend, neither will Italy say, hey, we're not going to rely on the Dutch interpretation, because the Dutch, again, back to step one, well, of course, they say the effective management's in Holland. So what do you need to rely on to finalize trend one? You have to rely on public international law, which is the practice of states. The practice of states, but not the two states in the conflict. Because the two states in the conflict got to the conflict by the nature of their interpretation of the rules. So you got to look at the practice of all the other states, and the OECD model commentary will help us understand the practice of states that are members of the OECD, obviously, but are relevant for this particular dispute. This is the practice of states who are subject to the OECD, from which the Dutch-Italian treaty has been based on. And the commentary help us to explain. So then we'll have to go look at the commentary in a moment. So that's a starting point, an easy starting point. But then to to be intellectually honest, the authorities on both sides, meaning the revenue authorities, the government's counsel, and the company's counsel, need to argue the practice of states, but for the two states that are overlapping their jurisdiction. So they got to look at what other countries do: Germany, France, Australia, UK, whatever. I mean, there's both civil law countries, so they'll probably look at the civil law states, what they do. But it shouldn't be exclusive to civil laws. Anyway, they make agreements about that. Okay, that's to be intellectually honest. There's a big hole in that argument. How can a judge sitting in Italy, I mean, just from an efficiency and time consumption perspective, much less the cost of knowing what all these laws are, or not the laws, but knowing the analysis and procedures and then application of these to the situation, how's the judge going to know? How's the government of Italy going to know the time it would take and the resources to expend to obtain that information? And so you're asking a judge to make a decision based on foreign law, to bring foreign law into it, but that's what public international law is. The two is the counter-response. These two countries have agreed between themselves to bring in a treaty, and treaty is covered by the Vienna Convention on Treaty, and the Vienna Convention on the Law of Treaties has certain aspects about the treaty that we're studying, and that's part of your Chapter 4. And then from the international law practice of states, as the ICJ, the International Court of Justice, defines public international law, which a treaty falls under, it states that international law is interpreted by conventions and treaties. Well, we have the convention and treaty, but now we have a conflict under it. So it's helpful, maybe in terms of the commentary, but not for the purposes of perhaps finding the census. Then we look at the practice of states, and it's not that they're in order one and the other. Again, of course, people see it differently, but maybe they're equal. Maybe one's higher than the other. Maybe practice of states should be above treaties. Maybe treaties should be above practice of states. That depends on your attitude, how you look at it. Maybe they should be equal. Whatever, the treaties didn't help us get out of the situation. Thus, we have to look at the practice of states, but for these two states. Okay, trend number 2. Some people say, well, is the whole is trend number 1. You can't ask a judge, a trier of fact, the authority, to go outside what they know. It's just not efficient or possible. And practice how many states? Do I got to look at 40 states, 30 states, 20 states? Can I look at 5 other states? It's confusing. So we'd have to use the law Italy, which I say is circular, and so why even have a treaty at all? But so I'm presenting you different trends of approach. That's still part of step 2, understand. That's not step 3. Once you identify what approach you're going to use in step 2, now you go to step 3 and you apply that approach. The problem with using the domestic law, Italy using its own law to figure out the treaty conflict of step 2, is that I don't think you ever get to step 3. I mean, you might claim, well, now I'm going to apply, but game over. You're just circular back to step 1. I think that's why Michael Edwards Kerr, in his theory approach, I think that's where Michael Edwards Kerr would go with his theory approach. As you read the materials, you may have a different perspective on it. That will bring us to a real step 3, where we would be applying international law, and then applying that under the procedural system of the country to which the conflict is being adjudicated. Because at the end of the day, there's a country, in this case Italy, which a Dutch company is seeking protection from in the Italian courts. It doesn't help it to go to the Dutch courts. Okay, I'm going to read your see some questions. Wouldn't the effective management in Italy be for the subsidiary at the most and the holding company in Holland? Well, where's the subsidiary located? So next, Susanna, a resident of the Netherlands, dependent on the numerous court decisions. Effective in the company, yes. Okay, so as addresses the first question, that's the point of this whole discussion. This isn't about the underlying investment. Italy is exercising fiscal jurisdiction on the holding company. So, at first instance, first glance, I said to start off, you would just think that's a Dutch company and that Italy would be levying on the underlying investment company, the subsidiary in Italy. But that's not our situation. So, in response to James, in specific response to James, that's why we have a conflict, because Italy is claiming jurisdiction over the holding company. So Susanna's thing is, in these decisions, is placed on effective management of the company. Yeah. So let's go look at the commentary. Okay, the way it sounds is an agreement between states on behalf of its people, with some benefit to the people, with the main benefits to the states as such. Am I missing something? No, you're 100% correct. As we said in our first week of lectures 5 weeks ago, the states have made this agreement, this treaty between them, to encourage direct investment to benefit the state, which utilitarian-wise, inevitably, depending on what theory of government you believe in, benefits the people. But this is about states seeking revenue and sharing revenue in respect of creating some certainty for foreign direct investment. States want revenue, states want foreign direct investment. States cannot always seek to maximize revenue and still get foreign direct investment. Thus, states have made treaties between themselves. So yes, you're not missing something. You've gotten it, at least from my perspective. And we said that treaties extend vertical rights, really diagonal rights to their people, because the treaty, as we drew a little diagram last time, we had, in this case we have Holland and Italy, and Holland and Italy sometimes have horizontal relationships, such as mutual agreement procedure, which we'll get to end this lecture. But really, what happens is you have the individual down here, and the individual is not bringing a claim here, can do under the treaty, under tax credit claim, example, because the other country is taxing it also, double taxation, or it can seek mutual agreement procedures with its own country to then go and do a mutual agreement with the other country, again, double conflict, double tax situation. But generally speaking, the first instance of a treaty being brought to bear is when this person right down here, I had a little stick figure last time, diagonally has this diagonal right, still vertical, but diagonal vertical right to the other country. It says, hey, Italy, you are incorrectly exercising your jurisdiction over me to collect tax. Okay, so I'm going to click on the commentary, text of commentary, and we flipped over to our text of our commentary on our left-hand side of the screen. I'm scrolling down. And what does the text of the commentary, since I know everyone's had plenty of time to study this over the last 2 weeks, what is our text of the commentary? Well, we already know, of course, it obviously says effective management. But under paragraph 3, what does effective management potentially mean? So we see under so here under like 23, I'm highlighting it for you. See it? Use my pen. Okay, I'm at 23, so you should see that on your screen. Now, what's the difference? This is an issue for y'all to think about. What's the difference between fiscal domicile of the operator versus effective management? Okay. Now, I'm scrolling down again. And I'm highlighting a sentence that says, competent authorities having to apply such a provision to determine the residence of a legal person would be expected to take account of various factors. And then this is where the answer to the question lies. So let's put little 1, 2, 3 and such of these various factors, such as where the meetings of its board of directors or equivalent body are usually held, where the chief executive officer or other senior executives usually carry out their activities. Everyone see where I'm highlighting? Where the senior day-to-day management of the person is carried on. That's number 3. Number 4. Where the person's headquarters are located. Number 4. Number 5. Which country's laws govern the legal status of the person? That doesn't have to be incorporation. We looked at commercial law versus fiscal law already. So commercial law, we talked about Japan in that circumstance. And you don't have to be incorporated in country to get protection of the law sometimes, and sometimes you are incorporated in country, but you don't have protection of its laws under the real seat theory for purposes of commercial law. Okay, then the next one, where its accounting records are kept. Whether determining that the legal person is a resident of one of the contracting states, but not of the other for purpose would carry risk of an improper use of the provisions of the convention. So competent authorities should not be given the discretion to solve such cases without an indication of the factors to be used for the purpose you may want to supplement the provisions, yada, yada, yada. So I said we'd end by looking at competent authority. But where it says that the competent authorities should not be just given discretion on what to apply, they have to agree this between them. This kind of harkens back to what I say is the Trend 1 approach, which is if you're not going to get resolution under the step 2 into step 3, obviously the resolution you favor. Now the taxpayer, the Dutch company, goes to Holland and says, hey Holland, do you really want Italy taking your revenue away? Do you really want where we would normally bring money into Holland, investment income into Holland, pay Dutch workers? We're going to have to fire everybody because Italy's decided to expropriate the assets, to levy a claim on these assets. Or we're just going to stop paying you tax. Let Italy let the tax. If the rates are the same, what do we care? Now, the rates are not the same, but assume they were. So obviously the Dutch government's going to say, no way, it's our money. We're the winner in this situation. So Holland has to then contact Italy and say, hey, competent authority here, and they have to agree on what factors they're going to agree on, i.e. Trend 1. Italy's not going to say, hey, you can't use Dutch factors, and Holland's going to say, well, we're not using Italy factors. So then what factors are they going to use? A combination, an overlapping combination. So some people say this is like a Trend 3 approach. If you have, let's just pretend that they each had 3 factors they looked at, and that 2 of the factors of the 3 overlap the same, which is hard considering language. Even though income in the UK and US means the same thing, it doesn't. I mean, it's the same word, it doesn't mean the same thing. So, but in theory, let's say that the 2 overlapped and the thirds on each side were disparate. Well, then they could agree to use the 2 that are the similar ones for them. But it never works out that way, because how one country may have the same word, but then under jurisprudence it applied differently. So they have to look at a different way of applying. Now, this doesn't talk about jurisprudence and application, so it's not exactly a Trend 1 situation that the commentary is referring to. But it's in the same vein. That's all I'm saying. Now, we see where it says Italy has made an opt-out, what I'm calling an opt-out. Here's the observation of Italy. Italy holds the view that the place, and I've highlighted it for you, you'll see it in a moment, that the place where the main and substantial activity entity is carried on is also to be taken into account. Is also to be taken into account. So that means the factors above and this factor when determining the place of effective management. And then you see the other opt-outs: Spain, Mexico, France, Hungary. Observations, you see the reservations below. And obviously you have to see the United States, because the United States applies an incorporation test, and they're not always going to give up the right to tax a company on its worldwide income. Okay. Anyway, for Italy, Italy has said that they apply where the main and substantial activity of the entity is carried on. I believe that a conflict in this situation will obviously have to go to competent authority if Italy doesn't give up its rights, because apparently, based on what you're reading here, in terms of this decree, well then not every, but many companies in Holland, holding companies in Holland that have these investments in Italy, where they do something in Italy to oversee the investment, will now all be subject to Italian tax on their worldwide income. And that's not going to be on for Holland. No way Holland's giving up that income. No way Holland's going to be the loser country in this. It's not understood that way in other countries. But Italy has been infamous in its history for applying its analysis to, or just simply, like with VAT, European VAT, Italy just taxes the foreign company and doesn't give the money back for inputs. Just doesn't do it. Or where they take years to do it. And then the EU started, the European Court of Justice started to, in one particular seminal case, I don't remember now, back in like 90 or 92, something like that, was the Italian government in a tax case would have to pay interest, would have to pay damage for not paying back the tax in time to the taxpayer. Okay, and for those of you in EU who take the EU tax law and so forth, you study those kind of cases. That's that summer course with Ned Olson. from the Norwegian revenue. Okay, so we see application of domestic law, treaty law under the competent authority article. Now, to go to the competent authority article, we have to actually go back to the text of our articles. Just going to quickly shoot back, and we have our mutual agreement procedure, Article 25. I put my mouse over it. I'm just waiting for it to come up on your screen, or I'll circle it so that. So when we talk about competent authority, what we're doing is talking about this Article 25 mutual agreement procedure. It'll be on your screen in a moment. Anyway, I've circled it for you. So, with Article 4, to refresh us, just to summarize, we had Step 1, we had application of domestic laws, Holland, Italy. Italy's applying its version of real seat doctrine, or its version of how it interprets residency. It levies tax. Now we have our overlapping claims. Our overlapping claims bring Step 2, how to resolve the conflict, and then Step 3 is the once we've agreed. Step 2 is we bring in the treaty. We have our Article 4 in the treaty. Paragraph 3, we agree a common, or hopefully a common interpretation of Article 3 is brought about. And then Step 3 would be the domestic court in Italy, or the revenue authority. Italy still has to give up its right. Since it's exercising its right in Step 1, it has to now give up its right and choose to be the loser state status. If it doesn't do that, then we have to come to Article 25, circled on your screen, mutual agreement procedure, i.e. competent authority. Most people just refer to it as competent authority, CA. If the two can't agree and you end up with double taxation and competent authority, I mean the two sides, i.e. the competent authority article, they can't agree and you end up with double taxation. Well then technically, shouldn't Holland give you a tax credit? No. Because Holland is, Holland's never stated, and you've never stated that you're not a Dutch company. In practice, what would happen is obviously that they would rearrange their affairs because, double taxation, they go back, they'd have to give up all their assets in Italy, or their assets would be levied by the Italian government, and they'll give up their assets and the investments in Italy. And that's the whole reason we have treaties, is not to have that situation occur. So presumably there'll be a result. Not always, but presumably. Okay, so we've looked at what I'll call a strange Italian decree, but hey, this is not a aberration by any means. This is happening all the time, not an aberration. So here you have a situation specific to application of a treaty, and then you see the actual conflicts that occur as relates to Article 4. You can imagine with Article 5, there's a lot more conflict, a lot more issues brought to bear. Well, what would be that forum? I see the question. What would be the forum for bringing about resolution? The company can go back to the Dutch government and say, Dutch government, you have to agree to give up because Italy gets the income. Why would the Dutch government give up? The company can seek a tax credit for the taxes paid to Italy under the treaty and under Dutch domestic law. they can seek that. The company is going to be very unhappy because, obviously, as you're aware, the Italian taxes are much higher than the Dutch company, than the Dutch taxes. Holland's been reducing its tax rate. I think it's down to 22.5%. Last I looked yesterday, when looking at this issue, I deleted my Word file with it, but I was looking at Holland yesterday, and I think it's down to 22.5% maximum rate, maybe 23.5. Anyway, you're not going to find resolution in the Dutch court for the Italian court. You certainly several tax issues at the domestic level have found their way to the European Court of Justice, and the European Court of Justice has been ruling on many issues of discrimination. It always comes down to discrimination and the interference with trade between countries, because you treat your people and the foreign people differently. Is Italy treating its people and the foreign people differently in this situation? No. Italy's exercising fiscal jurisdiction over its own companies, and presuming that there's no prejudicial application here, they're not treating the Dutch company differently. They're treating it exactly like they treat any Italian company, and imposing unlimited tax liability. Any other questions on today's lecture? Remember that we have okay, so everyone who was here for part 1, remember to follow up on those recorded lectures, webinars, live webinars, and so forth. I think they're important, otherwise I wouldn't have them here. They're certainly not here to waste time, because you don't have to watch them if you don't want to. I'm going to stop showing my screen. One moment. Huh. I have to make my screen big to stop showing it. Close. Okay. I'm going to I've given you your screens back. I'll go ahead and stop recording then.